Hello, this is Michael Glass from michaelglass.com, where we focus on making informed decisions about our financial future. And this is our Forex Technical Analysis Trading Plan for Wednesday, July 6, 2011. Before we begin our videos, we always like to start off with the disclosures. Any symbols that you see today should not be inferred as a trading recommendation. No matter what form of investing you choose, stock, forex, futures, options, they all have a level of risk associated with them. You can lose all of your money. Any strategy we use today are for hypothetical purposes only. Future results are not guaranteed, and as always, any investment decision you make is your responsibility. Trade at your own risk. So this is our Forex technical analysis, as we said, for Wednesday, and we're going to look at the price action from Tuesday and try to come up with the key support and resistance price levels. We'll look at the gold chart and compare it with some of the popular currency pairs. We'll come up with a low volatility watch list, an inside bar watch list, and we'll have an education spotlight at the end. As always, if you have any comments or feedback, please send them to contact@dnbfx.com. As always, we're going to start off with the gold chart, and we can see what we referenced yesterday, which was buyers finding value at the 1475. We got a little inside bar here on the light volume of Monday, and now we've rushed our way right back up to our what was once support, now is resistance of about 1510, and we're stopping at the 20 moving average. So there are two things to watch here. First of all, we're now in a new auction area, so will we break through the 20 moving average and move all the way back up? We'll certainly have to see. Also, as we look at the volume, we did get an increase in the volume, but we can still see that there's a little parity here between the selling and the buying volume. Would like to see it get back up to what has been average for the past couple days. So we had this big move up on lighter volume. So what we have to watch for is two things. Whether we're going to move through, and we come over to our hourly, and we can see volume, our point of control at 1508. That's where the most volume was over the past day. And we can see that we're overbought. So there is an argument that as we hit this daily resistance, there is an argument for our hourly charts to move their way back on down and either confirm that we're going to stay in this auction area or we're going to move higher. As we move over and see the relationship with gold and the dollar, if the gold is moving up, then the dollar is moving down. And we can see two things. We'll see in all of our currency pairs on our hourly charts, we'll see a flight back to parity, meaning most of our pairs, which were once away from our long-term moving average, today made their way back to that moving average. And thus we can still see the whippiness. Look at the whippiness on the daily of, yes, we're moving up, but it's just been so up and down and whippy. And then again, even though the sellers are in control as far as what volume is winning, but we can see the past 4 days here are much less volume when compared to some of our bigger moves. Again, as we come to the hourly, we can see on the pound dollar that we have come back to a long-term moving average. We have come back to parity, meaning we're in a neutral zone, not in a buy zone, not in a sell zone. And we still see the same thing. Our divergence with the dollar and the pound is getting greater, so we can see that the dollar is in control as it hooks back up, and the pound sort of hooks back down. And we can see that maybe there's a buy going to be setting up here, but it's not there now. So since we're already close to parity, our long-term moving average, we're in a neutral zone. This gives us an opportunity to sit and wait before we make a move on the pound dollar. As we switch to the euro dollar, we can see something very similar. Again, we saw a return back to parity. Now the difference here is that we are just fractionally below, but still in a neutral zone. So we'll come back over to our daily chart to get a gauge of what's going on here. And we're seeing, yet again, more light volume. So the theme of today is a return to parity and lighter volume. Sellers are still in control. We can see that although our light volume Monday, when half the market wasn't here, did pop above our downtrend line, you can see that the sellers came right back in today and said, no, we must return it back down. So are we going to break through some daily support here on the euro dollar? Well, we can see here that the dollar has taken control, which has brought us back down, but we're starting to see the euro hook back up here. So as the euro hooks back up here, we may anticipate seeing some sideways action after you can see we got a buy signal here. So we may see a little sideways action, but remember the dollar is above zero, so therefore it's still in control, which is going to allow this to move lower. So we'll need to see a little more weakness in the euro to get this continuation all the way back down to 1.4. Finally, we have the dollar Canadian, and of course we're watching a long-term downtrend. We were watching if we were going to make a flight up to the 50-moving average or return back down and test 8,300 again. Our theme remains the same. Light volume, seller volume is in control. So all three of our major pairs, we still saw light volume, and we still saw the seller volume still being in control. We did see a little spike with the dollar today with the Moody's downgrading the Portugal debt. But here's the other thing that we see today on our hourly charts. The volume, the price action returns back to parity. So we're back to the long-term moving average. We're back to a neutral zone. However, the one difference that we see here is we can see that the Swiss really spiked up. So the Swiss took control, which allowed for our price action to move lower as the Swiss took control. They're both above zero though, so we'll see if this bounce that we saw here will bring us back up to at least a sell zone that we can take action on. But what we're seeing on all three pairs are a move back to the neutral zone, a move back to our long-term moving average, and so we're going to have to let price action tell us where we want to go for tomorrow. So today for our low volatility watch list, we're going to be watching the dollar yen. And for our inside bar watch list, we do not have any current candidates. We do have some important economic events tomorrow, so I want to share those before we go to our education spotlight. As we go to our economic calendar, there's some things that should really jump out. We have a lot of jobs data for Wednesday. We have GDP for the European Union, so that certainly can move the market. And then we come down to, we have the Challenger job cut, which can move the market, but more importantly for the States, we have ADP. And this can be a leading indicator to Friday's employment situation. And we have another employment situation down here with the Aussie. So we have a lot of jobs data coming out tomorrow, and we have New Zealand with GDP. So we have a couple GDPs, and we have several jobs data that will definitely impact the market. As we continue to talk about what separates winning traders and losing traders, I would say number one at the list is actually having a trading plan. Actually having a strategy that they're trading on a consistent basis, and actually knowing how much they're willing to risk with that strategy. So many traders are out there willy-nilly throwing money at different trades, and they're different styles of trades, they're different strategy of trades, and then they're risking much too much or not enough. So if you really want to begin the process of becoming a consistent and profitable trader, the first thing you should do is define your trading plan. Test it out, prove it over a pool of trades, 100 trades or more. And that way you'll know that, well, I know 70 out of 100 times, 60 out of 100 times, even 50-50 may work depending on your strategy and your risk level. But the point is, you have to know that you have a tested strategy that you know at the end of the day it works, and that I will make money. My wins will outweigh my losses. The amount of money that I'm going to win outweighs the amount of money I'm going to lose. That's the other thing. People win more than they lose, but their losers cost too much, and so they wipe out too many of their wins. So that is huge for defining what separates winning and losing traders. Again, at dnbfx.com, we're focusing on developing winning traders. We're focusing on developing high probability traders. No fluff, no hype, just the facts. Thanks, guys, and I'll see you next time.